Hi, welcome to today's Tuesday talk. And today we'll be while covering the performance of the markets and factors and sectors over the last week, month, and year to date. We'll also be talking about an interesting investment portfolio framework, and that's going to be the theme for this month, the rest of the Tuesday talk. And we'll talk about how to integrate and how to go about thinking about your investment portfolio framework. So I think that should be know, focus for this month, given the turbulence in the markets and all that we are seeing. So I think this should be an interesting topic to cover. With that, let's get into the performance of factors for this week. And on a weekly basis, not been a bad week at all. Remember, this is the week ending Friday last, which is the 1st of July. So qualities bounced back, values bounced back, and low volatilities bounced back. We also seen a small bounce back in small cap and all. Monthly, this is pretty much the picture for the month of June. Remember the month ended on 30th of June, but we are just taking it to 1st of July till Friday. So pretty much everything was down. Momentum, small cap, quality, value. Low wall lived up to its name and was down the least. Year to date, also everything is down, and but the market, the broader market is down 10%. The small caps are taking a bigger hit, and that's the key takeaway. That part of the market is taking a big hit. In terms of trend, all factors still are in a downtrend, so no change over there. In terms of sectors, FMCG gained the most, and metal and realty had a bit of a bounce back, I would say. Auto is trying to make its way into an uptrend. Let's see where it takes them. Except for banks, pretty much everything else was flat or in line with market. For the month to date, it's auto and FMCG, the two sectors that have been in an uptrend as per our trend barometer. So those two sectors have done well. But year to date, it's been energy which is still holding in the green. Autos are number one at 7.1%, and FMCG down up about 3%. IT is taking the most of the brunt, followed by realty, followed by metal. So so no major changes there, except on the uptrend. It looks like auto and FMCG, which are FMCG, of course, comes from the low wall theme, but it's auto which is the surprise, because it's usually an economy sensitive. Is also a leading sector usually in the recovery. So let's see, some hope there. In terms of trend, like we said, only auto and FMCG are in an uptrend, and rest of the sectors still remain in a downtrend. If you want all this in your inbox, just go to factorinvestor.substack.com, and on a monthly basis, we will send this to you in your email. With that, let's move on to the factor all weather, and we've updated that data also on the 1st of July, and we still remain in a risk-off mode as per this model. So even for the month of July, no allocation to risk on, no allocation to any of these factors. It's 100% allocation to gold as per this model. So, because as you've seen even in the factor model, none of the factors are in an uptrend, not even low volatility now. So quality may be perhaps one of the early ones which we may see get into an uptrend, but for the month of July, we're going to stay in risk-off mode as per the factor allocation model. With that, let's move on to our topic for the week, which is your investment allocation framework. We talk about personal finance, but we forget that we talk a lot about finance, we forget a lot about the personal aspect of that. So what are the dimensions one should consider while thinking about your own portfolio? Remember, if you are ill and somebody else is ill in your house, you don't take the same medicine. You have to go to a doctor and get a dose prescribed for your illness because your body type, your weight, you may have some certain other pre-existing allergies or things like that. So your medicine cannot be the same as someone else's medicine. It may be similar, but it has to be approved by a doctor. So when you're looking at personal finance also, you have to look at your life circumstances. You have to look at your risk ability, your risk tolerance, and even experiences. We all have different life experiences. People who start their in investing in a bull market are sometimes very different from people who start their investing in a bear market. So sometimes our life experiences are different, our life circumstances are different, but I would say the most important is the difference of risk ability and risk tolerance, and remember those two are not the same thing. So don't miss the personal and personal finance. With that, let's look at the framework. There are three dimensions that we have to consider, and this framework is from a book called The Aspirational Investor, also paper written by Ashwin Chabra, who was the head of Merrill Lynch Wealth Management, Global Wealth Management, and currently he's the head of the family office of Jim Simons of the Medallion fame. So he's written a very interesting book and paper on the wealth allocation framework, and I think that's a very nice and elegant and comprehensive way to think about risk in your portfolio. So there are three aspects to consider when it comes to bucketing your portfolio. The first is personal risk, where basically your standard of living should not be jeopardized. So here the emphasis is on reducing downside risk and on safety. So here somewhere you should be willing to accept below equity return because you are taking lesser risk. The emphasis here is on principal protection, on preserving your lifestyle. So even in a worst case scenario like COVID or like the great financial crisis or a dot-com bust, this aspect of your life should not be jeopardized. So here the assets that you are going to invest in are going to be very safe and will give you slightly below market kind of return. Second is the market risk, where you have to invest in where you will be able to maintain your lifestyle in the future. So these are mainly where you should be getting a market return. And market returns, when I say market return, I mean equity market returns, broad equity type returns. You may have a mix of assets in this portfolio, but maybe you're taking high risk in equities, you're taking some risk in fixed income. So it should be balanced from a risk and reward perspective. But broadly, they are going to help you to maintain your lifestyle in the long run. And the third bucket is your aspirational risk, where even if this allocation of yours goes to zero, it has no bearing on the first two ones, which is your jeopardizing your basic standard of living and maintaining your lifestyle in the future. Those two should not be impacted at all, even if your entire allocation here goes to zero. So here it could be very high risk return kind of asset classes. So if this investment pays off, it could take you to the next orbit in terms of your lifestyle. But in case it doesn't, it should not change the fact whether you're going to go your retirement purpose comes down, or whether your kid is going to go to college where you want them to go or not, or whether you wanted to buy a house in the future. So those kind of things should not be impacted in case the allocation to your aspirational risk allocation goes to zero. So, that's broadly the investment risk allocation framework. We're going to talk about these three dimensions in detail over the next few weeks. So that's it for today. Thank you for listening to us. Remember, this is not investment advice. This is purely for educational purposes only. Please consult your investment advisor before investing. You can follow me on Twitter at Anish. You can follow us on at Cap, and you can go to our website and sign up for our weekly newsletters and our monthly newsletters and fact sheets, where we send you details on our CMS performance and what we hold in our portfolio and things like that. So with that, have a good week ahead. And that's it for today. But don't forget to like, subscribe, and follow our YouTube channel. Thank you, and see you next week. Bye bye.